My name is Vasilios Roussos. I run the DCU Fintech Innovation Center. We're a nonprofit program that supports the growth of fintech startups in the city. One of our cohort members that started this past summer is Chris Lustrino from KingsCrowd. And you'll see from the signage around that he's the one who's leading the charge and organizing this event and putting it together. We're all here to discuss equity crowdfunding and specifically within self-directed retirement investing. This is a topic that I think we've seen the enthusiasm around the room from just me talking to a couple of different people who are interested in everything from the compliance aspect to it, to using this platform versus investing as an angel, to just understanding about this sort of new wave. And so what we really want to delve into is why does this exist and who's it really for? So with that, why don't we turn it over to introductions? And Rob, do you want to get us started?
Sure. Hi, everybody. My name is Rob Burnett. I'm with Netcapital. We're a funding portal, so we're one of the sites that hosts these kind of new private deals that are available now to everyone through the Jobs Act. My background is I was an associate at Techstars. Before that, I was in law school. Before that, I had a couple startups of my own.
Awesome. Mark?
Terrific. Hi, Mark Peck with Rocket Dollar. We're a retirement services provider. We help provide self-directed tools that allow you to invest in private assets through IRAs and 401ks. I handle our business development and partnership efforts on the East Coast. Been working in the private placement and alternative asset space for over 10 years, both from the sort of the sell side here on our side of it, as well on the buy side from a family office perspective.
Hi, everyone. I'm Chris Lustrino, founder and CEO of KingsCrowd. Kind of the one-liner about our business is we are the morning star of this equity crowdfunding market. So we have Netcapital, which is phenomenal. We also have 45 other platforms that enable online startup investing. Our job is to go out to all 46 of those, find every one of those deals, collect all of the analytics on them, and then actually rate and diligence those companies, just like a traditional venture capitalist would, and work on behalf of investors in doing so. Basically, I was in private equity consulting out of college in 2014. Thought there had to be a better way and thought, why should I work for others to invest in the private equity markets when I would love to do that myself? Discovered this world of the Jobs Act that was enabling anybody to be able to invest. Got really excited about that, started a fintech blog, ran that for about 2.5 years, which was eventually acquired by John Fanning, who's the founding chairman and CEO of Napster way back in the day, and asked me to come build this company, and here we are 9 months later.
Awesome. So take a pause for a second and want to thank the sponsors of the event tonight. So this is Robert from First Republic. Yep. And so Robert is the tech banker and connector of startups in the city and always does everything first rate, including the menu today. So thank you. And is Steele here? Nope. T3 Advisors and Steele is the additional sponsor of tonight's event. So thank you. So Rob, why don't you kick us off and just tell us quickly, what is equity crowdfunding?
Sure. So in the past, there were two major types of investments, public and private. And so it used to be that everyone had access to the public markets and they were highly regulated and there was lots of information and there's a whole ecosystem around ratings and analysts and stock markets and prices going up and down. And then there were the private markets that were basically a black box, that were only accessible to about 3% of Americans, accredited investors, and deals were all about who you knew and what you could get in on and how much money you had. And for investors, this was tough because you had to know the right people to get the right deals, and most Americans were just stuck with only the public markets. And for entrepreneurs, it meant that to raise money, it was all about backroom deals and knowing the right people and shaking hands and having the right network. And so with the creation of the Jobs Act, the passing of the Jobs Act, and the implementation of the regs, there's now this whole new space called equity crowdfunding, or Reg CF. And what that allows companies and investors to do is companies can file some paperwork with the SEC and raise money from anybody. And investors, whether they're accredited or not, can now have access to these private deals for the first time. And so there's all types of crowdfunding websites, Netcapital being one of them, and all types of deals, everything from a local brewery to high-tech advanced materials to biotech, and now kind of all of America has access to these deals.
Awesome. How many people in this room have invested in equity crowdfunding? Well, it's pretty good.
All right.
pretty good numbers. So, Mark, can you tell us what is a self-directed IRA or self-directed investment program?
Sure. Well, it's sort of a long-winded way of saying that you can invest in any asset class permissible under the IRS and Department of Labor guidelines. So, to Rob's point before, the idea of public versus private markets, you've always been able to invest in private assets through a retirement account. The issue has been getting that access through an efficient channel at a fair price. And so Rocket Dollar's value proposition is offering a very efficient platform and tool that really opens up that pool of money to let you invest in interesting and cool things. So it opens up the access to a brewery, a high-tech fabrication company, as well as some other alternative asset classes like real estate, private equity, hedge funds. Really, the entire spectrum of assets are unlocked through self-directed accounts.
Awesome, thank you. And Chris, why don't you give us an update? What's the state of the market today, and is this crowd representational of that market?
Yeah, it's a great question. So on the investor side to date, we have a lot of work to do, right? So we've had about 1 million investors partake in these online private markets. There's 300 million Americans that can now partake in this space. So we have 299 million more to go find. Regardless of that, what we've seen to date, so there's actually 3 regulations, and that's something that a lot of people don't realize, that enable online startup investing. So there was actually 2 issues that existed. One was that if you weren't a millionaire, they thought, never could be smart enough to be able to invest in a private company. The other one was basically you couldn't solicit advertising online for investment. That rule also went away, and something called Reg A Plus and Reg D 506C were created, which enable online startup investing across the whole spectrum of companies. So we have pre-seed companies you never heard of, like myself, who've raised a couple $100K in friends and family rounds and things like that on platforms like this. And then you have pre-IPO companies via platforms like EquitiesN and SharePost, et cetera, that are doing late-stage secondaries and things like Uber and Lyft, et cetera. In this core market that everyone kind of knows of as regulation crowdfunding, we've seen a couple $100 million pour in over the past couple of years. The growth is astounding. We've had over 1,000 deals to date. And when people think about this space, they think the quality must be poor. There's going to be self-selection for any company can't raise traditional capital is going to go this route. And that's just not the case. That's not what we're finding, especially. So what we're actually starting to see is some VCs are coming in and doing side-by-side deals with some of these companies. So Reg D 506C was actually legal 5 years ago. If we look at the 2013-14 cohort of startups that raised online via Reg D 506C, WeFunder across our entire portfolio has about a 53% net unrealized IRR, including Checker and Zenefits, which are both billion-dollar unicorn companies. Seed Invest took every one of the investors on their platform, which there's about 200,000 of today, and said, what's the median portfolio return? Again, net unrealized IRR, and they had about a 17% unrealized return. If you look at the VC market from that same class, same calculation, the median VC portfolio return was 11%. So if you start to think about what this market's doing, it's basically saying, let's not source from 3 key cities and only give it to a bunch of white males, which only represents a very small portion of society, and actually have more diversity and inclusion, find deals from a broader swath of the population, and have a lot of people decide what's actually good based on data and not just on heuristics.
Awesome, thank you. Just realized we're 4 white men on a panel, so.
I realized the exact same thing.
A little sad, right?
Yeah, so we need some good Q&A from the women and non-white men in the audience. All right, so let's start off with the basics. Can you tell me, Rob, public versus private investing? What do you need to know?
Sure. So public investing, I imagine most people in this room are familiar with it. There's a million options. There's a ton of information. Most of it is available in big publications like the Wall Street Journal, Morningstar, et cetera. In the private markets, now I'm going to stick mostly to the Reg CF space because the private markets are vast and complicated, and most of it we don't deal with in our little ecosystem. In the Reg CF space, you got to understand that most of the companies you're working with are very early stage. They haven't gotten to the point where they can be public and handle that regulatory burden, so they're earlier on, they're highly risky, and it's all about portfolio strategy. So if you want to make money in the private markets, you either have to be really lucky or you have to diversify. And so picking one company to try and ride, you might make it, chances are you won't. But if you buy a wide swath of investments in this space, like Chris said, over kind of the broad industry, returns have been really pretty good over the last couple of years, but nothing's guaranteed. And it's all about kind of doing a lot of due diligence, reading things like KingsCrowd, doing your own research, reading offering statements, et cetera.
Can we ask questions from the audience?
Yeah, please do. Yeah, jump in.
So I have a question on that, right? So 11% return on VCs, 17% on this sort of thing. But what you just said kind of doesn't really make sense to me because, okay, well, let's say I, a private citizen that don't have any VC background, right, go and just try to diversify my portfolio. My return is not going to be 17% because I don't know how to diversify my portfolio. So what's the control variable here? Like, what's the average type of person? What's their return?
So, Chris, you can help me with this, but
Sure.
What Chris did say is across the entire seed investment portfolio, which is another site like ours, the entire portfolio, not accounting for any individual smart investor, that was 17%. So the average investor on their site was getting 17% IRR. But that being said, you're right. This is not an easy asset class to access. You should learn about what it takes for a company to be successful. You should understand things like team is important and the size of the market's important. And a company might sound like it's a great idea, but do they have any traction? And Chris, you can talk about what you look for.
Sure. Yeah, so basically, when it comes to the diligence process, you're right. A lot of people come into this market. What we've actually seen is a lot of individual private citizens haven't touched it because they're a little scared. They're a little nervous. They don't feel they have enough information, which I totally get. That's why I built KingsCrowd. So we kind of always call ourselves the decision engine of this market, right? We provide education, we provide research, we provide the ratings, and we provide the analytics. So the education and research are actually really important components of this as well. So for us, it all comes down to helping you understand the terms of a deal. What's a safe? What's a convertible note? What's a common share? So we teach you those things. We try and help you learn what all of that means before you even go and look at a deal. And then what we do is we actually go and look at these companies. Now, my whole background is in private equity diligence. The team that we're hiring out is people all with private equity, venture capital diligence experience. So we go and we actually do the diligence funnel, right? We go through and we look at all of the companies. We drive them through the funnel. We only end up recommending, 5-10% of deals is really interesting. And then what I always tell people is diversification in many ways is very easy, which is if you have $2,000, do not put $2,000 into one company. Put 100 into 20 companies. Typically 20 plus is where you start to get that diversification point. If you put in 20 hours of diligence on a company and you invest in 20 plus companies, the risk of having just a negative return is reduced drastically. It does not mean that you're not going to have negative returns or you won't have a bad day, but it does mean that you improve your chances of having success over the long term if you do all the right things. You don't have to be a genius, but you do need to understand the basics.
Yeah, and I'll just add a point then from our perspective. So Rocket Dollar is here to help provide another pool of assets that can help you make these eligible investments. And so the idea is to provide a tap into your retirement dollars to invest in these really specific industries. And that's where often the conversation that I have with a new consumer would be, whatever experience you've had from a professional and personal capacity and where your interest level lies, that's where I would start focusing. So if you're a science, a STEM professional, or real estate, logistics, whatever your expertise lies in, that's where you probably want to start digesting and gathering information on, right? Because you're in a position to assess those companies, and that's really your edge over other folks coming in. So what it does is it helps you really pinpoint the asset class you're passionate about, where the public markets traditionally, you might have an ETF that touches on that from a high level perspective, but you just can't get as specific. And that's where the self-directed tool, when paired with these kinds of resources, can really help you, allocate to 3 specific deals that you feel comfortable with.
Yep. And so there's a lack of an index fund, basically, right now for the industry to sort of cheaply make a quick decision. You can hire an expert, which today is Chris, right, to have some hopefully positive selection bias. Or you can create your own diversified pool of at least 20 companies. But is that reasonable for an investor? I mean, how much money do people put in? And what do you need as an individual to get into this game and do it effectively and responsibly?
Sure. So on Netcapital, our minimum investment size is usually $100. So by Chris's math, having $2,000 to invest could theoretically get you a nice diversified portfolio. Every site's different. Some sites have minimums of $1,000. It varies widely across our industry. I think in general, focusing on a diversified portfolio and not investing anything you can't afford to lose. I think at the end of the day, this shouldn't be your investment strategy. It should be a portion of your investment strategy and probably a small portion of your investment strategy. The one thing I'd also say about this type of investment, and I'm not sure if it fits here or not, is yes, you're investing for return, but I think this is also a great place to invest for passion and to invest in the things you believe in. By the time a company gets public, it's usually very large. It's usually doing $100 million in revenue. They've kind of made all the change they're going to make, and then they're going to go and be a nice, big, steady company that employs a lot of people. In this space, you have a chance to, we've had rocket companies that want to change the way we access space. We've had biopharmaceutical companies that want to create new opioids and new cancer drugs. And yeah, a lot of them might fail, but you might just invest in the company that actually makes the next big, great change in the country and hires a whole lot of people and changes the face of a town or a city. And so I think that's one of the really exciting things about this space.
Are you seeing any of the larger players in the investment industry getting into what you guys are doing? And if not, why not? Because you see that in like the robo-advising.
Sure.
You see that like everybody wants to be a robo-advisor now. But
Yeah, so a few things there. One, probably the clearest indication of seeing that is side-by-side offerings, where back in October, I know there was a side-by-side offering with Coastal Ventures, one of the most famous VC funds out there, doing a deal on Seed Invest, and everyone else was partaking in it as well. There's a company on Pongolo that was also on Seed Invest that was doing a side-by-side offering with a few different VCs, and then they said, you know what, you're like a Netflix for the Latino population. You should probably go and do some marketing. This is a great tool to raise half of your capital and also get a great audience. And so we are seeing VCs kind of get into that game. The other thing that we've heard is family offices and hedge funds. They kind of want to play in this space as well. One of the things that's never existed in this space, again, is transparency and access. So the only ones who could really do it were the ones who were taking the time to go and meet the founders and whatnot. Now that it's available online, it's like this is a new way to be able to have a diversified strategy within their own portfolio. So we are seeing a movement in that direction. And then I won't talk to larger companies, but I can tell you there are very early talks with many large companies, take your pick in the financial world, that are starting to think about how do we create those diversified funds? How do we get involved? What analytics do we need? So it's definitely a discussion that's on the table.
I do think, though, there's a lack of the technology being applied from those legacy companies. So a firm like Netcapital has an advantage and a head start on them from their approach in terms of the ease of use, right? And sort of combining these together is a digital experience as opposed to the very manual and paperwork intensive, private placement market as existed previously. So though the intention might be there, we don't see a whole lot of traditional funds really embracing the electronic sort of mechanisms, and a lot of that just has to do with the risk in the record keeping, but slowly but surely. Yeah.
Are the side-by-side deals that you're seeing, are they the same terms?
Yeah, that's right. Yep, it's same terms. They actually have to be legally on these platforms. Everything has to be equal for everyone. The information, there can't be any, I know something that you don't know. Everything has to be out there in the open. So there's actually even Q&A sections on these things that are regulated by the SEC. They'll come and chat at you. Same everything.
Yeah. We'll answer that question in 1 second.
Diversity here?
Yeah, absolutely. Okay, jump right in.
Market makers.
Yeah.
The market makers. So that's where I would say is one of the lagging issues in this space. We were just talking about it before this discussion. Everyone came rushing into the market and was like, let's build the marketplaces. These are the tools. But then where's the market makers? Where's the morning stars that are helping people make informed decisions? Where's the people with a lot of money who can actually funnel in big dollars into these deals? Where we know one of the largest asset class that people have is their retirement dollars. We should be finding a way to untap that, and they're finding a way to do that with Rocket Dollar. So we're starting to see those tools come into play, but there's not enough right now. I would completely agree that they don't exist.
There's certainly an acknowledgement from the entrenched players that market making is a needed addition to this pool. And so certainly some of the biggest names on the street that have made their name in market making and public securities are wading into this and applying those same tools into this space, but it's not mature, the offering.
Rob, you might mention our secondary market capability, because that's in essence where the market makers are right now, or other people on the portal.
Of course, yeah. So on Netcapital, every security sold, unlike previously where private securities were illiquid and you had to wait till a company either got acquired or went public. On Netcapital, we have a secondary transfer platform where every share is liquid and is theoretically can be bought and sold by new users, returning users, founders can buy back stock, et cetera. And so we expect to see that that market grow. We'll see people starting to make markets. We'll see liquidity start to get created. And like everyone's saying, it's early days in this space.
Picking up on the earlier thread about equity and structure, can you just talk to us for a second about what do you actually get? Can you walk through what a piece of equity in a crowdfunding deal looks like?
Sure, and the whatever equity you buy is going to vary deal to deal, and I think one of the biggest kind of pieces of advice I can give to people shopping for deals is understand what you're buying, because each site does it differently, and there's a lot of terms that can get very confusing. On Netcapital, we only do common stock. So we've tried to build a security that looks very similar to a public security. So you're buying a public security, you're buying stock on Netcapital, but it's a common stock. It's usually the same exact type of security that the founder holds. So if the founder does well, you do well. If the founder doesn't do well, you don't do well. But there's other types of securities. One's called a note or a convertible note. That's usually a debt instrument that upon a later financing will convert into a certain number of shares. And then there's a safe instrument, which is similar. It's called a simple agreement for future equity. And again, it's kind of a promise that someday you will get some equity at some point. And each of those instruments have specific terms. Sometimes you get a discount on the next fundraise, et cetera. But I recommend being very diligent about understanding what terms you're buying into when you purchase a security.
So correct me if I'm wrong, but a safe is in many ways similar to the term like a warrant, right, from the public perspective? Or what's the difference there? I know that people sometimes throws around the future right to buy the security for equity.
Yeah, honestly, so since we don't deal with safes, and I have never dealt with warrants, I don't know the exact subtle differences. I won't try to make it up, but they are both kind of the ability to buy securities in the future.
Do you only sell common, or do you sell preferred on your side also?
On Netcapital, we only do common stock.
But maybe, Chris, you can talk about other platforms and what they offer.
Yeah, I mean, like you said, it really varies, and also there's certain platforms that do multiple things. So I've done a Netcapital and a Start Engine raise to date. We've raised about $167,000 on Netcapital. It's all common. On Start Engine, we continue to keep with common. We believe that's the right thing to do, but they offer a convertible note. On WeFunder, it tends to be a WeFunder safe, which is essentially a Y Combinator convertible note safe, whatever you want to call it. Republic is only the safe. And then Seed Invest does a wide range of things. They'll do common, they'll do preferred equity, they'll do convertible notes, and they'll even once in a while do a safe. And those are kind of the 5 big ones. And then microventures, I think they tend to do convertible notes and common shares.
How do you keep up with right offering?
So we actually built a tool that tracks all of the platforms and pulls all of the deals into our database. And basically on a weekly basis, they come flowing through our system. And then we could go one by one, picking them off and say, all right, let's go and look at this offering, let's learn about it, and then go through our process of diligencing.
I mean, like if I invest, let's say I invest $1,000.
Oh, how do you keep track of your investment?
How do I keep track of? Now they're doing a Series A. I don't want to get diluted. How do I get, does it follow the Jobs Act? Does it follow that same sort of path to give me the right not to be diluted?
It'll depend a lot on whatever you invest in, right? You might invest in a preferred security on one site that gives you follow-on rights. You might invest in a note that has nothing. On Netcapital, we usually don't have stated follow-on rights. It can be hard to do with this type of fundraise. Yeah, so a lot of companies have opened up either sidecars or opened up around after a Series A or something like that to allow people to follow on, things like that, but it's never guaranteed.
Can you talk to us about, was there a question back there? Sorry.
Can you talk a little bit about some of that operational stuff? Is it all seamless to the investor once you go in on the site, so you don't have to worry about custodial services, transfer agency, any of the back office stuff?
So I can speak for Netcapital. We do handle all of that stuff. Part of our service is you basically you sign your proxy, your vote to a custodian and a transfer agent, and all of that's taken care of. And all your shares are kind of held on Netcapital. You can see it all there. We make it very simple, but every site's different. So I can't really speak to the other sites, what their backend looks like.
Yeah, I mean, I'd say the vast majority try. The whole idea of this was to simplify the process, 10x, right? So the vast majority are handling all of those things and making it as simple as possible for the investor.
Yeah, and I would just say when we're bringing in retirement dollars, the goal is the same, where we're trying to make it an efficient digital process where you're really, executing all steps along the way to get you to that endpoint where you're really in a comfortable position where that, all the I's have been dotted and the T's have been crossed without a lot of manual paperwork and manual review to maintain that position.
So Chris, why don't you tell us about the red flags?
Yeah, sure. So when looking at these deals, we actually have something on KingsCrowd called the Underweight Deal Series. But we basically have 5 key components that we always look at in a company, and they're the very traditional venture capital things that they look at as well. So that's market size. Is this team solving a really big problem? That's product or service differentiators. What makes them better? Who are the competitors in this space? Why am I going to go buy them versus someone else, right? We look at the founding team's experience. So if we're actually going to recommend a deal, 80 to 90% of the time we actually get on the phone with them and chat with them. If it's really impossible, we won't do it. But the vast majority of the time we try and talk to them because so much of investing in an early stage company is believing the founder could find a way to make this thing successful. Just because the first idea doesn't work doesn't mean they won't pivot and figure out how to make it work. So typically having experience, being people who have put the right people around them in order to execute, those are the types of people that you want to back. We look at the terms of the deal. What stage of the company are you in? What valuation are you raising at? What are other companies that are in the space that are doing similar things raising at? Are you reasonable based on those expectations? And could I expect, a 5-10x return if you continue to perform? Or is it already way too high where, a lot of that price is already built in? And then we look at the business model. Can this company actually scale? Is this something that can be profitable in the next 5 to 10 years? And it's not just going to cost them tons and tons of money to go acquire a very small user base. So understanding all of those things is really important. So then the red flags typically comes into, well, how many of those don't look very good? And one could be the killer for sure. You could just say, wow, the market size, for instance, there was a company in Texas that was a candle company. They were raising at a multi-million-dollar valuation with 50,000 in sales, and they had 1 store in Texas, and there was no discussion of expanding to any other stores. That's a really big red flag. I guarantee you Texas, even a big state, probably doesn't have a $5 million market size in terms of number of candles being sold. So anyway, it just seemed highly unrealistic that you're going to get a 5 or 10x return or any return at all, right? So those are major red flags, but sometimes it's more nuanced. And so you have to look across multiple dimensions like, well, the market is actually slowing down and it's a little bit of a saturated market in terms of competitors and their terms are a little high. So if multiple things start to hit for us as red flags, then we'll also say, you know what, I think we want to keep our hands out of this one. So knowing that those are kind of the key dimensions, you could start to go through and just logically say, does this make sense? Does this make sense? And if a few hit and say no, it's probably a red flag. If one hits in a major way, that's also probably enough to say, maybe I shouldn't touch this.
But the candle company is still listed?
We list it as an underweight deal, as a company that you shouldn't touch.
But you can't. Right, like a private investor who doesn't look at your...
Oh, sure. Yeah, absolutely. Now, the nice thing is when you say it's underweight and you also recognize that everyone else probably feels the same way because they've raised $100, and it's like, okay, everyone has been smart enough to know this is probably a deal not to touch. So typically, it's I would say the vast majority of the time, if we feel that it's underweight, it's also from the public's attention an underweight deal as well.
What is your service called?
KingsCrowd.
Yeah, what does it cost?
Costs. So it's $10 or $20 a month based on which level you get. So Reg CF, which is kind of a lot of what we're talking about here tonight, is a $10 version. If you want Reg A Plus and Reg D 506C as well on all of those deals, it's $20 per month.
And are you raising money now?
So we will be raising money very soon. Maybe.
You could
Maybe
have
online,
gotten in
maybe
at a
offline.
fantastic price on the first equity crowdfunding platform. And so, Chris, do you have to be the Warren Buffett of this industry, i.e. Chris, to get these founders on the phone, or can any of these people in the room do that?
Yeah, great question. So I would say at the end of the day, it is hard to get these people on the phone. I mean, some of these raises that are really successful could have 1,000+ people invested in the deal. You're not going to get on the phone with 1,000 people. So what we try and do actually is host webinars. So if you're subscribed to KingsCrowd, if we really like you as a founder, we'll bring you on and actually host a webinar so that people can come on. So we had one today with a company called Ground Floor. We had the founder on. We had about 200 people on the webinar asking Q&A. I mean, it was crazy. But that was their opportunity to be able to ask questions directly to the founder, which otherwise is really, really hard to do. Now, you have the Q&A section on all of these pages, so you can go in and ask different questions. But I would say we're one of the better conduits to be able to do that.
Yeah, and for the record, Netcapital is also doing webinars now. So any company that's raised over $25,000 on our site will go and do a live webinar. So you can sign up, and for our weekly newsletters, we announce them, and it's a great chance again to meet these founders, start to talk to them, and see if you like what they have to say.
I'll say from my experience, that Q&A section, if you post something, they do get back to you.
Oh yeah,
And if
it could ruin your
back and
race.
forth, you can pick up the phone and talk to them. So.
Excellent. Do you have a question?
Yeah, thank you. So if the candle company made it into your radar, does that mean that you probably saw something good, or do you accept?
Oh no, we look at it. So the way it works, there's 46 FINRA registered portals that enable online startup investing. We basically track every company on every one of those 46 portals. Good or bad, we at least collect the information on them. Whether or not we invest, that's another decision. Or say we would invest is another decision. But we do track everything within the online private market that exists today.
Okay, but tracking it doesn't mean that you selected and accept them into your platform.
So we are not a platform. Our whole job is to rate the market. So we rate every company from great to terrible, is essentially how it works.
And I think I might be able to get at what you're asking, which is, so there's the funding portals. So you should think of us like the New York Stock Exchange or the NASDAQ or any other. We're the exchange, right, where people go and purchase securities, where companies go and list. And now each portal or each funding portal has its own requirements for what it takes to list on that site. And so some have really heavy due diligence processes and only let a tiny fraction of companies come on their site. And so then on a site like that, it's up to you to decide, do I trust their due diligence process? On Netcapital, our goal is to democratize access to capital. So we don't sit as we don't do what Chris does, is we don't do a VC style auditing of the company. Instead, we've got a very strict SEC process that they've got to disclose a certain amount of information to basically make sure that they're not fraudulent. They're a real business. They're real people really making a good faith go at it. But if they're doing that and they're willing to jump through all of the hoops to go and raise, and it's not particularly simple for founders, on our site they can list. So the candle company wasn't on our site, but there are sites like that that are more local businesses that are trying to raise from their local constituents. And for a lot of their investors, it's actually not about a big return. For them, it's about, hey, I buy my candles here, I buy my flowers here, I buy my groceries here. I want to just be a part of this thing that's in my local community. And so that's another reason why it's very important to kind of read through offering statements to understand what the business is doing, because not all businesses on all of these portals have the same objectives. Not everyone wants to be the next Uber or next Facebook. Yeah.
So Mark, can you tell us a little bit about, why is this an opportunity, right? And why should an individual invest in their retirement savings account?
Yeah, absolutely. So it's typically an untapped pool of assets in reference to these private assets we've already touched on. And so really our goal is to unlock that and empower you as the individual to go out and make these choices. And so there can be some difficult diligence that is put on your shoulders, but that's really the empowerment that I think is also the goal for most investors. They want to be able to be that focused. And so what's really incredible about using a retirement account is it takes away some of the portfolio building pressure that using your taxable assets does, right? I'm the father of young kids and have a family and a mortgage, right? If you are loading up on illiquid securities and are locked up into long time frames, that can be a problematic choice from you from an allocation perspective. But retirement dollars really match well with the long durations. Whether or not you use the secondary liquidity function, you can feel more comfortable with a 7-year time horizon and be patient with that position. You did your diligence, you used all the tools that are available to you, and so you're able to have patience and take that long view. Because you're really forcing that position through a retirement account, right? They're all tax advantaged and there are time constraints on when you can access those dollars. And so it matches very well with longer duration, longer maturity investments.
So can you tell us who's it for? Like what demographic of person and why is it important to them?
It's really for anybody who's passionate and excited about maximizing their savings. Our core sort of demographic is really 25, 65, 70 in that professional income earning stages of their career or really capping off their retirement at the tail end. And so again, I would say that it's for anybody who's got a level of expertise or interest in any particular field. The field may just be private investing itself, or it may be something even more nuanced, like candle making. If you're, a very passionate and experienced, manufacturer of candles, that could be the widget for you. And so it really lets you tap into that passion, whether it's a geographic interest or an asset class interest, or just for your own education as an investor. I think that's what gets people excited about it.
And earlier, I know you had mentioned social impact, right?
Yeah, absolutely. I mean, there again, it allows you to be very specific beyond buying, their social impact ETFs and some of these tools that exist today, which are certainly have the right, we all can appreciate they have the right goal in mind, but the actual conduit and the actual tool just doesn't achieve the same level of specificity that these investments do. And so, there's a lot of interesting companies. We were talking about one earlier that's helping, fractionalize real estate deals in different communities across the country. I mean, that's a really specific way to invest in Baltimore, Pittsburgh, Houston, wherever your interest lies, you can really drill down into that.
So that one was Arcs Urban, DCU alum, just got to make the plug. Rob, why don't you tell me about something exciting at Netcapital? Brady Industries could be one of them. Chris told me a little bit about that, and that's sounds like a pretty big deal.
It is. We're excited that they're on our platform. I've got to be a little careful. My job's not to sell anyone on any deals, and so I won't. But there's what is exciting is that there are big companies that have raised a lot of money off the site that someday, whether it's Brady or there's lots of other companies, that they want to go public, but companies have been pushed so far downstream to go public because the regulatory burdens are too high and it's just too hard and they can't get the underwriting. And so we're starting to see a couple of these companies that they've raised lots of money. They're real businesses that have been around years and years and years and employ tens and tens of people, and they maybe want to go public someday. But they're just not quite there, but they want a larger base of investors. They want more people to have access. And it's an exciting opportunity to get into, have access for the first time to these pre-IPO companies that you never would have had access to before.
Yeah. So since I'm not a platform, I can give some of the fun facts. I believe, Chris, correct me if I'm wrong, that they have raised over $100 million. It's a professor from MIT who is a serial entrepreneur who has created and patented a number of technologies and is working with the state of Kentucky to bring this to market. And so, is that right? And what does this mean for the industry to have a 9-digit raise?
Sure, yeah, so to be clear, basically they're working on raising hundreds of millions of dollars to create this metal tech company. One of their advisors, for instance, is Michael Porter. If you know Porter's 5 Forces and have ever been to business school, you probably know his name. This is a really big deal, a really big company that's trying to build this massive plant in Kentucky. And they want to build a grassroots movement and help people be engaged in this project, right? They're going to try and employ thousands of people in this state. They should probably get them involved. What better way than to let them own a little piece of the company? And so this actually helps them do that. But what it also does is it says to the industry, this isn't just about, pre-seed startups, really early stage things. This is about, completely disrupting the model of who utilizes equity crowdfunding, online startup investing. This is about, middle market deals can occur. There's $13 trillion in assets in the private markets. The IPO market has been dying since 2008. It's been slashed from 8,000 companies in 2008. Today in 2019, there's about 4,000 companies. Companies are staying private longer and longer. Getting access to the actual growth stage companies is extremely hard. Suddenly, these companies that are, $400, $500, $600 million companies can go and raise the capital from the broader public in a simplified way and provide access and transparency in a way that's never existed. But it also says, hey, we're really legitimate and we're here to do serious things. It's not just, these cool new age tech startups that might not pan out. These are serious businesses that are trying to do something that's, monumental. And I think that's really exciting. It just kind of puts things on the map for the industry.
Yeah. I think it's important to understand on a macro sense, because IPOs are getting pushed later and later, the vast majority of growth in the American economy happens in the private markets. So all of the wealth is getting created, and it previously was funneled to 3% of the population. So you wonder why the economy might be, a little bit broken. And now we're just starting to pry the door open to this massive wealth generator to everybody, basically.
And people will always say, just to hop in there, that the UK is about 5 years ahead of where we should be today. They were just much quicker with moving through the regulations. They had a company called Monzo Bank. It's a new age, tech-enabled bank. They raised $20 million in 48 hours from their own customers. They just said, hey, customers, we're going to offer you the opportunity to own a piece of our company. And they sold out $20 million in hours. I think we're probably going to be there in the next 5 years, because if you start to think about it, imagine Uber and Lyft, right? 5 years ago, had they been trying to compete, how do you keep people on your platform? Well, you let them own a piece of it. So instead of Uber going to Bain or whoever they went to and raise $20, $30 million to grow, they just go and raise $20 or $30 million from every one of their drivers and users, and suddenly they're actually committed to that company. So I think it's going to be a really powerful tool, and as we continue to improve the regulations and just get more people involved in this space, I think we'll see more deals like that.
So investing in your retirement and allowing a new asset class, if not in total because of the industry, at least by stage, which is to your point, Chris, can help on sort of a risk-adjusted return basis. But why would somebody not want to do it? What are the risks and concerns?
Well, I think you just have to be really honest with yourself, with your own ability to assess these companies and assess the terms that you're being provided and your own appetite for doing that diligence and sort of the ongoing monitoring and maintenance of your portfolio, right? We all, I think, agree that the set it and forget it is not the right way to build a portfolio. And so, you've really got to be conscientious that it's going to take a little bit of work to get started. And as well, no matter how passionate you are about one position, you can't over allocate to it. And so, at Rocket Dollar, though, we are very excited about unlocking retirement dollars for these private assets. We still encourage you to follow, an allocation strategy that has exposure to the public markets, fixed income assets, and those traditional asset classes are still important. This is not to say that you need to throw those out the window. They should be a core part of it, and here you begin to really dip your toe into the water, 5% here, 10% there, and before you know it, you've got 40% stocks, 20% bonds, 40% private assets. I think my math's a little off there, but either way, you want to make sure that you're really engaging at your own personal comfort level. Our path, none of our paths is a set one for you, right? That's the idea here. There's freedom to choose, but at the end of the day, it's your choice. So you better feel good about the decisions you're making.
Okay. And what about from a tax perspective? What's the implication?
Well, the accounts we're talking about are tax advantaged. And so the idea is some of them are pre-tax mechanisms where you're capturing, contributions go in the door and they help you reduce your income in the current year, and you're deferring those taxes until you retire and take the money out. So they have sort of their own unique profile there. The second half of it, which is a really powerful way to look at these high risk, high reward transactions, is through a Roth or post-tax money type. Once you've already paid taxes on it once and you contribute those dollars into an account, if you wait until you're 59 and a half to take them out, they're going to be tax-free. And so there have been a lot of use cases and examples across the industry where folks have, made some good strategic bets. They're 20 investments. If you hit one winner there and you've got a unicorn on your hands in a Roth IRA, you've really just created a pretty amazing wealth vehicle for you and an amazing way to keep your assets tax advantaged.
Very cool. What about liquidity? Can you talk about that for a second?
Yeah, so in the private markets, part of the reason why traditionally they've been so risky is that there's not a lot of liquidity. So traditionally, when you invest in a startup, and for the vast majority of deals at any of these platforms, the only way to get liquidity, to get a return on your investment, is either for whatever you invested in, whether it be real estate or a company, for the most part, companies, either that company has to get acquired or it has to go public. And we know that companies are rarely going public these days, so really it has to go get acquired. And as the economy does well, that might happen a lot. If the economy turns poor, it might not happen very often. And so a big reason why using retirement dollars or just having a long time horizon is important is you just never know when these companies are going to get acquired. As an intermediary, as kind of another alternative to that, Netcapital has introduced our secondary transfer platform. So again, any stock you buy on our site, you can turn around and sell. And so, if a company's doing well, there might be a nice market for that. People might want to buy in. If you bought into the next Uber and things are on the rise, you might be able to get out at a nice, increased, a nice return on investment. But for a company that's failing, you might never see liquidity in that stock, whether or not you can post it for sale. And so it's a big part of investing in these stocks is being prepared to be in it for the long haul and understanding that even stocks that might have some theoretical liquidity might not, whereas others you might be able to get nice return on.
Let's do a speed round. All right. What's the future of the industry? What's going to happen over the next year?
The next year or the long-term future?
Why don't you give us both? Spend
Okay.
30 seconds on both. We're going to put everybody on the spot.
I think this year you're going to see a lot more of these kind of pre-IPO middle market companies start coming to these platforms for capital. And in the long term, I think you're going to see a kind of parallel ecosystem to the public markets of these private deals that are going to be a huge part of people's portfolios. There's going to be kind of hundreds of billions, if not trillions of dollars unlocked to invest in these deals, and you're going to see a massive shift into transparency.
Thank you.
I think a further adoption of technology into other asset classes. I mean, these guys are leading the way with equity crowdfunding, and other groups are taking notice, and they are trying to evolve as well. And I think just the desire from a consumer perspective to have really seamless tech-enabled tools. It's not sufficient any longer just to provide a passive sort of hands-off, dump everything in the consumer's lap and expect them to figure it out. You need to provide value-add tools and continuously updating those with the technology advancements that come.
Chris? So I think the big thing you'll end up seeing is a consolidation in the market. So right now, like I mentioned, we have 46 FINRA-registered platforms that enable online startup investing. I would imagine you start to see a bunch of those get kind of bought up and consolidated. What you'll also start to see is a broadening of smaller firms that do specialized deals, healthcare like Red Crow, PropelX that does big data and AI. So you'll start to see specialization at the bottom and then these big players at the top. And what I think that also does is it enables the institutions to kind of come in and start to say, okay, I know where to pick and choose and put my dollars. And so I think you'll start to see a little bit of an institutionalization as well. Those market makers that you're talking about before come into the space, especially if we start to see a couple of wins. And there's some companies out there that could be really interesting over the next couple of years to watch that have already raised in this space. Once you start to see some really interesting returns and opportunities come out, I think you'll start to see a flooding more of people into this going, oh wow, there's something really here I hadn't been paying attention to.
Very cool.
Especially when those retirement dollars start leaving the Fidelity account.
Yeah. Awesome. Do we have any questions from the audience?
Is there an idea of a carry, or like how DCs have an annual carry, I believe? Is there something like that in your industry?
So on Netcapital, no. Netcapital charges the company a fee of kind of a % of the amount raised. But in terms of carry, we don't take investments in the companies on our site. There might be some companies that do have something like that, or some funding roles, but not us.
Yeah. Well, if someone could just talk to the fee structure for putting a deal on a platform, and is there a fee to the investor, or what's the fee to the company?
Again, portal specific on Netcapital, there's usually a small upfront fee to companies to list, and then we take a percentage of the amount they raise, and that's the kind of industry standard. What that percentage is fluctuates. Sometimes if you use credit cards, there might be a fee, things like that. But I don't know, Chris, if you...
Yeah, no, I would say average is 5% fee to the company of all funds raised. Small upfront fee for the company on some of the platforms, not all, and typically no fees to the investor.
Just from our perspective, we are interacting with the endpoint consumer and user. So we have a fee arrangement with the consumer who's using the product. We're not going out and soliciting a deal on behalf of one of these platforms. So there's no sort of traditional broker-dealer mechanism where we're selling their products through our retirement accounts. We're providing that conduit and the tool, and so we're charging the endpoint client.
Do you see your fees potentially going down when you look at companies like Pensco that's owned by Opus Bank, drilling it down? Because I actually visited your website and checked out your...
Yeah, there's certainly been compression. I mean, I think so our fees are flat fees, and the big difference between that and others, so we charge $360 to get started, and that's the whole setup, which gets you enabled with really a checkbook control function, and then $15 a month flat fee. And the difference there between the traditional players and us is we charge no transaction fees and no fluctuating fees based on assets under custody. That's traditionally been the financial services model that's really frustrated people, is that we're enabling you to make choices, and your choices are dictating your portfolio performance. So why should you pay us more or less based on your performance? We're performing the same service whether you win or lose, so we feel like it's justified to have a flat and transparent fee, not a fluctuating annual or monthly, quarterly fee, whatever it may be.
Question in the back?
Do companies need to report quarterly earnings? How do I know?
So typically the way it works is you have to file an annual report within, I'm not going to quote myself on the number of days, but after doing a Reg CF raise. And then you have the option to continue to do an annual report, which some do decide to do. Other people will say, I'm going to basically file something that says I'm not going to continue to report unless I do another raise, in which case it reenacts.
And then like on our site, we encourage our companies to give either monthly or quarterly updates to their investors, but it's not the same as like a public company where there's quarterly earnings reports and things like that.
And do those come through you and you funnel them to all the investors since you know?
On our site, yes. On other sites, depends.
What about regulation? Is that going to change?
So the hope is there's a few things that can occur that would improve this market. One, right now, Reg CF, which is the easiest thing to do for a startup, you could raise $1 million per year from non-accredited investors. They want to increase that to $5 million because there's already a cap on the individual. So the reality is every individual is only going to get hurt so much even if the company goes under, right? So capping how much a company can raise is a little bit counterintuitive and doesn't actually help that much. So we want to raise it to $5 million. You get a lot more Series A companies that would be interested in doing this if that's the case. The other thing is, and Netcapital is actually a special case that's awesome, but a lot of the companies, you'll end up with a lot of people on your cap table. Now Netcapital has a really cool structure that actually makes it all one line item, and it's awesome when you do a raise on there because it keeps everything really simple. However, not all the platforms have that. So they want to create an SPV just like in a traditional Reg D where everything essentially goes into that one line item. And so they're trying to work on that as well. If those two things change, I actually think it could be really positive for the market.
If I want to raise money through Netcapital,
Sure.
say as an S corp, for example.
S corp, no, because there are kind of tax implications around S corps, number of shareholders, foreign entities, et cetera, that just make it really complicated. But LLCs are C corps for sure.
What's the quick minute tutorial for an investor who's thinking, for an entrepreneur who's thinking about listing on your platform?
Yeah, so it's basically a three-step process. The first is a compliance step. So a big part of this regulation is you need to basically file documents that disclose a bunch of information about your company. It's actually not super onerous, and Netcapital has a system where you just fill out the form. Chris has gone through it, fill it out, and then we auto-generate those documents for you. Second part is coming up with a plan. So we'll help you create an offering page. It's what lays out what the opportunity is, what investors are going to read through, what they're going to kind of see in the sales pitch, and then we come up with a fundraising plan for them. So help them talk through kind of how they're going to go out and raise money. At the end of the day, if there are entrepreneurs in this room who are thinking about going down this route, the reality is that money never rains from the sky. No matter how good your deal is, at the end of the day, securities are sold; they're not bought. People aren't going shopping and hoping, for the most part, to buy securities. You need to go out and pitch your company and sell people on the future you're trying to create. And so we help them do that.
Awesome.
So historically, a lot of the regulatory change comes from high-profile frauds. It seems to me that there's a great risk of that. I mean, do you have any concerns about that bad actors are going to cause problems for your industry?
I can take it real quick from the retirement side. It's interesting the point you make, and you're absolutely right that from our perspective, we don't want to be interacting with or helping show in our network companies that are going to be bad actors. I would say it's been interesting to me what I've seen over the years is that those bad actors come from really esoteric and late night TV pitches and things like that. Like they are not from this flavor of the industry. They come from a push mentality that really represents, I think, the old guard of what alternatives have been. And there certainly have been some bad investments for folks. And that's where we take it very seriously of who we engage with and who we would highlight on our site as a partner referral. But it seems like this new wave, we have not seen that experience so far.
Yeah, another way to put it is, I think all of them went to the ICO world, and that's why they're creating regulation now. There's a reason this market didn't blow up, because it is regulated. And at the end of the day, they make it really easy, but it's still a huge pain. And you have to get bad actor checks if you own more than 15% of the company. You have to have an operating agreement. You have to show your board resolutions. If you're going to go through all the effort of creating a scam, you'll probably just go do a scam instead of do this. It's not worth it.
Yeah, and just to add on that, I think there's statistics out there that 80% of ICOs were scams. At least so far, knock on wood, of all the Reg CF races, there hasn't been a documented case of fraud. Now, it doesn't mean companies don't fail, but there hasn't yet been a case that someone's done a Reg CF raise as kind of a fraudulent entity and just like taken the money and run. So we find that really encouraging. It's too hard. There's not enough money in it. Not yet, anyway.
Awesome. Last call for questions.
Do you focus on one crowdfunding site specifically, or as an entrepreneur would you look at and possibly engage with more than one, diversify?
So from a regulatory perspective, if you want to raise money and you're an entrepreneur, you can only use one site at a time, just regulatorily.
And Chris, would you go crowdfunding? That's my favorite thing this way.
Yeah, I mean, I think if we don't, then who should, right? But I am a believer, actually, that you should probably go cross-platforms. We've seen companies build really loyal bases on one platform. They just continue to raise money and they crush it every time. We've seen others who utilize multiple platforms because we actually don't see a lot of crossover between each platform. So oftentimes, if you go on another one, you're getting a whole new base of people to be able to tell your story to. And so it could actually be a really good way to kind of build momentum and continue to raise capital.
Potentially, you might be on Netcapital pretty soon.
Regulatory would say that you shouldn't say anything about those types of things.
All right, and last comment, Mark, how we talked about entrepreneurs, millennials is the other hot demographic. Everyone wants to know, what are they thinking, what are they doing? What's their activity and point of view for a self-directed program, especially around crowdfunding?
I think it's very constructive, and there actually, to the regulatory point, there was just some recent legislation passed by Congress that's going to update some of the 401k and small business contribution functions, the way that those are structured. So I think we feel positive about the ability for people to engage further, and to Rob's point, to really try and democratize this space. And so we certainly want to take down those barriers and open the door to new folks, because they're eligible, just as eligible as anybody else, to swim in these waters. And I think, when it comes to retirement dollars, half the battle is just getting money in the door. So even if you're not ready today to maybe, take some of these steps and engage, you're doing the best thing for yourself by participating in your company's 401k plan, by at least making some personal contributions to an IRA, and just starting to engage and feel comfortable investing on your own, which will lead you to more interesting options, if you will, down the road.
Let's take a final poll. So the people who have invested in equity crowdfunding that raised their hands earlier, can you re-raise them? Wow. I think there's more hands than the first time. Keep your hands up. Who now is going to invest in a new equity crowdfunding based on what they've learned tonight? A couple more people. And how many will put that, of all of these people, how many will put it into your retirement account? Okay, we got a couple, and a couple are pending. All right, awesome. So personally, I've been super excited to do this, super excited in knowing all of these people and the efforts that they're putting forth. I truly do believe that we are on the forefront of something new and exciting in the fintech world that is going to be impactful, not only to the entrepreneurs, but to individuals for their sort of investment health and financial wellness by the ability to do this through self-directed 401ks and other platforms. So I think we're all on the forefront of something truly exciting. And for me personally, I reflect back on starting my career working with endowed institutions, and these are people with hundreds of millions and billions of dollars in assets, and they hired many consultants to help them figure out exactly what the efficient frontier was and where is the best opportunity for each asset class, and to democratize all of that through the tech-enabled solutions that these people are doing, I think is just a very cool thing. So thank you all. And thank you, Steele and back.
Can I ask you one last question? What are the limits on investors?
Yeah, so it's if you're non-accredited, it's a little bit nuanced, but it's basically around $2,200 or 5% of your income, whichever is less. And if you're married, it's slightly different, but it's all within.
$2,200 is you can always invest up to $2,200.
Always up to $2,200 or 5% of your income.
Yeah, or
right?
more if 5% of your
if you
income
get up
is
to
more
5%.
than that.
There you go.
Sorry, that's a little confusing.
All right, thanks everybody. Enjoy the food.